Hi guys, I'm Karunya Rao, and in Ideas for Profit, we talk about IIFL Wealth. The business of managing wealth is looking up thanks to the buoyant capital markets and a large under-penetrated space. India, after all, is one of the fastest growing wealth markets globally, both in terms of the number of ultra HNIs as well as wealth levels. This space is mostly dominated by private sector lenders, but the contribution of wealth business to these banks' total profit remains minuscule. For instance, Kotak Mahindra Bank is the largest wealth manager in the country, but more than 60% of its net profits come from banking space. Hence, the best way to play the wealth space is through a pure play wealth manager, and here IIFL Wealth can offer an exciting opportunity. While the market opportunity is huge and is likely to grow in sync with India's economic growth and rising income levels in the economy, there are more reasons to consider IIFL Wealth. Unlike lending and other financial services, wealth management is largely a fee-based business, and hence it's relatively low risk with limited exposure to credit events. Moreover, wealth business requires limited capital for growth, and it can potentially generate non-linear profit growth and high ROE. The biggest reason for our enthusiasm is the high proportion of annual recurring revenue earned, which makes IIFL Wealth's revenue relatively more stable and predictable. The company has catapulted itself to the position of the third largest private wealth management firm in India, offering a full suite of services to clients, including the likes of distribution, advisory, asset management, broking, and even lending. Under wealth management, the company has an advisory platform. It's called IIFL One, and it offers investment solutions to ultra HNIs under a single fee structure. The company does not earn any commission from the fund house, but rather it earns a contracted fee from its clients. If you look at the AMC business, the primary focus is on alternative investments, which includes the likes of private equity, structured credit, real estate, and even portfolio management services actually. Mutual funds form a very small portion of its total AUM. IIFL Wealth is among the largest managers of alternate investment funds, also known as AIFs, in India, with an AUM of 27,000 odd crores as of June end. The wholly owned NBFC IIFL Wealth Prime had a loan book of 3,350 crores as of June end, mainly comprising of loans against securities. It largely supports the wealth management business by providing loans to clients as a temporary bridge for their liquidity requirement. IIFL Wealth is backed by marquee investors like a General Atlantic and a Fairfax, which further gives it an advantage to raise debt in the capital markets. The capital requirement, however, is small and limited for the NBFC's sponsor commitment in AIFs and working capital to cover the interim operating expenses. Now, if you look back, previously it has utilized capital raised for inorganic growth and acquired a couple of smaller wealth firms and an NBFC. In fact, it purchased the wealth business of L&T Finance in April 2020, which added about 9,900 crores to its AUM. IIFL Wealth's revenue is in the form of commission and trail income from distribution of financial products, brokerage, interest income on the NBFC book, advisory fees, and management fees. As of June 21, the wealth management segment accounted for 81% of the AUM, and asset management formed about 19%. Wealth management contributed 75% of the overall revenue, while AMC formed 25% of the revenue pie. In the last few years, IIFL Wealth's profitability was impacted by a change in the revenue recognition model and the mark-to-market losses on its AIFs. SEBI's decision to ban upfront commissions on distribution of mutual funds and to cap total expense ratio adversely impacted revenue of IIFL Wealth, as most fund houses passed the cut by reducing distributors' commissions. What we like about IIFL Wealth, first up, is the proactive transition to advisory model. IIFL Wealth's business model underwent a transition following the big regulatory changes. The revenues are now recognized on a trailing basis even for PMS as well as AIFs. The transformation of business model is visible as the company now earns revenue through fee-paying clients under IIFL One. The platform has seen healthy growth in assets and has crossed 30,000 crore mark in June end. The advisory model, meanwhile, continues to gain acceptance across clients and the broader industry, and this can help reduce regulatory uncertainties associated with the distribution fees from the manufacturer. The management strategy to focus on increasing share of ARR as opposed to transaction revenue is quite encouraging, and it has helped reduce volatility in revenue. IIFL Wealth received the highest quarterly net flows ever in Q1 FY22. Also, the overall retention rate, which declined to 0.57% in FY21 due to transition in business model, it's now showing signs of stability with a slight uptick in retention rates for IIFL One. The management expects a CAGR of 12 to 15% in AUM and profit CAGR of 18 to 25% from FY21 to 26. With the increase in share of ARR assets and cost rationalization, ROE has already improved from 7% in FY20 to 16% at the end of June quarter. Management expects to reach ROE of 20% going into FY23. Moreover, its guidance of paying 75 to 80% of its net profit as dividend is something to watch out for. The company's revenue, however, is exposed to fluctuations in the capital markets as well as regulatory changes. Technology can also be disruptive as AI-based wealth advisors are gaining popularity. We see IIFL Wealth's business on a sustained growth path driven by rising millionaires seeking wealth advice. Earnings are likely to be strong in the near to medium term, which will drive the stock upside according to MC Pro Research. At the current market price, IIFL Wealth is trading at 26 times FY23 estimated earnings, which is reasonable considering improved business fundamentals and visibility of earnings growth. Therefore, we advise long-term investors to start accumulating the stock.